If you bought silver this morning because of the headlines, I need to tell you something. You just became exit liquidity. Yesterday, the financial world exploded with one of the most bullish predictions anyone had ever seen. Bank of America, one of the biggest financial institutions on the planet, released a research note saying silver could hit $309 per ounce. The prediction was everywhere: Twitter, financial blogs, email newsletters. Retail investors saw that number and panicked. They thought they had to get in immediately before silver went to the moon. So this morning, Wednesday, January 7th, they rushed into the market. They drove the price of silver all the way up to $82.75. It looked like the breakout everyone had been waiting for. It looked like the start of a historic rally into triple-digit territory. Then the trap closed. At the exact moment euphoria reached its peak, a massive wave of selling crashed into the market. The price didn't just stop climbing, it collapsed. Right now, silver is trading at $78.54. That's down $2.62 on the day, more than a 3% drop. If you bought at the high of $82, you're already down 5% in a single afternoon. This is a textbook financial maneuver called selling the news. The smart money used the bullish headline to offload their positions onto the late arrivals who chased the hype. In this emergency analysis, we're going to dissect exactly what happened today. We're going to explain why major banks release bullish forecasts right at the top of trading ranges. We're going to look at the dangerous double top that just formed on the chart, a technical signal that suggests we might fall even further. And we're going to show you how to survive this volatility without losing your position. The headline said $300. The chart says $78. You need to know which one to believe. This is the story of the Wednesday flush. But first, you need to understand how the biggest players in the market exit their trades without destroying the price. To understand today's crash, you need to understand how a whale exits a trade. Imagine you're a hedge fund manager. You bought millions of ounces of silver at $60. Now the price is at $80. You're sitting on a massive profit. You want to sell, but there's a problem. If you hit the sell button, your order is so large it will crash the market before you can exit. You need buyers. You need millions of buyers to step up and absorb your position. So how do you find millions of buyers? You need a headline. You need a story so exciting that retail investors rush in without thinking. Enter the Bank of America report, silver to $309. Whether by coincidence or by design, this report created the perfect liquidity event. When retail investors read that headline, they flooded the market with buy orders. They built a wall of liquidity at $82. And the hedge funds said thank you. They sold into that strength. They sold into the greed. They used the retail buying pressure to absorb their massive selling pressure. This is why the price crashed the moment the news went viral. The smart money was distributing their shares to the late arrivals. It's a tale as old as markets themselves. Buy the rumor, sell the news. The rumor was the breakout. The news was the price target. And the result was the crash. Now let's look at the technical damage, because charts have memory. Traders remember exactly where they lost money before. Look at the chart from last week. On December 29th, during what traders call Ghost Week, silver spiked to $83.71 before crashing. That was the first rejection. Today, January 7th, we rallied to $82.75 and got rejected again. We failed to break the previous high. In technical analysis, this pattern is called a double top. It looks like the letter M. It's a bearish reversal pattern. It tells us aggressive sellers are defending the $83 level. Every time the price approaches it, they step in and hammer it back down. This creates a ceiling. Until we break $83.71 decisively, the breakout is on hold. But there's something else happening in the market that makes this situation even more dangerous. We need to look at the leader, gold. Gold is trading at $4,453. It's down $32 today. While silver dropped 3%, gold only fell about 1%. This tells us the selling pressure is spread across the entire precious metal sector. It's not just a silver problem, it's a precious metals problem. Why is gold falling? Most likely because of the bond market. Yields ticked up slightly today. When bond yields rise, investors sell paper gold. And when gold gets sold, silver gets hit 3 times harder. That's what traders call the high beta curse. On the way up, silver moves like a rocket. On the way down, it drops like a rock. But notice something important here. Gold is still holding the $4,400 level. It hasn't collapsed. It's just consolidating. This suggests today's move in silver was an overreaction. Silver responded too aggressively to the downside, just like it overreacted to the upside this morning. It's acting like an emotional teenager reacting to the steady parent that is gold. The parent is fine. The teenager is just having a mood swing. We need to discuss the psychology behind a $300 price target. When a bank like Bank of America releases a number like that, they're talking about a long-term forecast. They're talking about 2026 or 2027. But the retail investor reads that headline and thinks it means today. They think silver is going to $300 by Friday. This mismatch in time horizons is what causes the massive losses. The bank analyst is looking at a supply deficit that will take years to play out. The day trader is looking at a 1-minute chart. The day trader buys based on a long-term forecast, but uses short-term capital. And when the price drops $2, they get stopped out and lose everything. You have to align your timeline with the thesis. If you believe silver is going to $300 because of a structural shortage, then what does a $2 drop on a Wednesday actually matter? It doesn't. It's just noise. But if you're trading with 20 times leverage trying to catch a breakout, a small move like this destroys you. Today was a brutal lesson in time frame management. The destination might be $300, but the road there is full of violent corrections. But here's the thing. We can't dismiss the Bank of America report entirely because something much bigger just happened that nobody's talking about. The fact that Bank of America, a bank historically known for being short on precious metals, is now publishing bullish price targets is a massive signal. It means the narrative is changing at the institutional level. In the precious metals community, Bank of America is known as the Death Star. For years, they held one of the largest derivative short positions in history. They were the hammer that kept silver prices suppressed. They told their clients that silver was a waste of time. They called it just an industrial byproduct with no real value. But yesterday, the Death Star fired its laser in the opposite direction. They released a report that didn't just upgrade silver. It repriced the entire asset class. They said that in a bull case scenario, silver could top out at $309 per ounce in 2026. The report was written by Michael Widmer, the commodity strategist at Bank of America. He's not some fringe analyst. He speaks to the largest money managers in the world, and in this note, he admitted 3 things the banking cartel has denied for decades. Admission 1. Supply is inelastic. The report acknowledges that miners cannot simply increase production. They admitted that even if prices rise, mine supply will remain flat or falling for years. This destroys the argument that higher prices will fix the shortage. They admitted the shortage is structural. Admission 2. Solar demand is unstoppable. For years, banks claimed that solar panel manufacturers would engineer silver out of the equation. They said engineers would replace it with copper or other materials. Bank of America just admitted that this is false. They now project that the green energy transition will consume silver faster than we can mine it. They validated the supply crisis scenario everyone's been warning about. Admission 3. The monetary premium. They linked the price of silver not just to industrial use, but to gold. They said that as gold breaks out to $4,500, silver must follow to maintain the historical ratio. They admitted that silver is money. This is a total capitulation. It's the financial equivalent of a general surrendering his sword. The bank that fought hardest against silver has just admitted the math is undeniable. Why does this report matter if the price crashed today? Because pension funds don't trade based on YouTube videos. They trade based on research notes from major banks. Imagine you're a conservative fund manager handling the retirement savings of firefighters and teachers. You want to buy silver, but you're scared. You don't want to get fired if the investment crashes. You need cover. You need a piece of paper from a respectable institution that says it's okay to allocate capital into silver. Bank of America just handed them that paper. But now we need to ask the cynical question nobody wants to answer. This report is a green light for institutional capital. It tells the pension fund world the water is safe. The fundamentals are real. You're not crazy for buying this asset. This removes the reputational risk of owning commodities. So while day traders were panic selling the news today, the real money, the large allocators, were reading the report. They were forwarding it to their investment committees. They were preparing buy orders for next week. The report plants the seeds for the next wave of institutional capital. It takes time for a massive ship to turn around. But Bank of America just spun the wheel. We have to ask the uncomfortable question. Why would Bank of America publish this report now? If they were short silver, wouldn't they want to talk the price down? Yes. Unless they aren't short anymore. The only logical reason for a bank to publish a $300 price target is if they are now net long. We believe that over the last month, during the Ghost Week volatility, Bank of America likely covered their massive short position. They used the liquidity chaos to exit their trap. And now that they're out, they want the price to rise. They've switched teams. They went from being the suppressor to being the promoter. They want to create a mania because they're now positioned to profit from it. This explains the violence of the rally in early January. It wasn't just retail investors buying. It was the banks front-running their own research reports. This is how Wall Street works. First, they crash the price to accumulate at the bottom. Then they tell you it's going to the moon so they can distribute to you at the top. We're now in the tell you it's going to the moon phase. And while that sounds cynical, it's incredibly bullish for the price long term. You want the banks on your side, and now they are. When a major institution puts a number like $309 into the public consciousness, it changes what's called the Overton window. Before today, if you said $300 silver, people would call you insane. Now they say, well, Bank of America thinks it's possible. It normalizes the idea of extremely bullish prices. It moves the goalposts. Suddenly $80 doesn't look expensive anymore. It looks cheap compared to $300. This psychological shift is critical for sustaining a price bubble. You need the public to believe the upside is massive. This report creates a self-fulfilling prophecy. Traders buy because they think others will buy. Refiners hoard inventory because they think they can sell higher later. Miners hold back supply because they're waiting for the Bank of America price. The target itself creates the behavior that makes the target come true, but we still have a problem. The chart is bleeding red, and we need to figure out what happens next. So the narrative is bullish. The banks have flipped, the institutions are preparing to enter, but we still have to deal with the massive red candle on the chart. We have to deal with the fact that silver is trading at $78, and technical analysis doesn't care about Bank of America reports. It only cares about price action. If you're a technical trader, looking at the silver chart today makes you feel sick. We just printed a huge red candle. We failed to hold the $80 level. And we formed a structure that looks dangerously like a double top. Let's be honest about what the bears are seeing right now. On December 29th, we hit $83.71 and crashed. Today, January 7th, we hit $82.75 and crashed again. This created two distinct peaks. In technical analysis, this is the classic M-top or double top pattern. It suggests buyers are exhausted. It suggests there's a massive wall of supply sitting above $82, and the market doesn't have enough buying power to break through it. If this pattern plays out the way textbooks say it should, the price should fall all the way back to the neckline. Where's the neckline? $70. That's a long way down from here. That's why you're seeing panic all over social media. Technical analysts are screaming, sell, because the pattern says we're going lower. But here's the problem with that analysis. In a supercycle driven by inflation and physical shortages, technical patterns often fail. A double top often transforms into a bull flag or a high handle. Instead of crashing to $70, the price simply moves sideways. It consolidates. It digests the excess supply. And then when the sellers run out of ammunition, it rips through the double top like it was never there. I believe we're forming a handle, not a top. Why? Because of the volume. Look at the volume on today's sell-off. Yes, it was high, but was it panic level high? No, it was profit-taking high. It matched the volume on the way up this morning. Now look at the bid support. Every time the price dipped to $78.40, it bounced immediately. We're trading at $78.54 right now. We're not crashing through the floor. We're sitting on top of it. This tells us there are passive buyers waiting at $78. These are the institutions we talked about earlier, the pension funds. They didn't chase the price at 82. They waited patiently. They let the traders flush the price down to their level. And now they're quietly accumulating millions of ounces at a discount. When you see high volume but the price refuses to go lower, it means accumulation is happening. The metal is changing hands from weak holders to strong holders, and strong hands don't sell. They hold for the next major move. But where exactly is the line in the sand? Where does the bull trend officially break? The critical zone is built between $75 and $78. $78 is the immediate support level. It was the breakout point from earlier this week. If we hold this level, it means the bull market is incredibly strong. It means we didn't even need to retest the lower support zones. $75 is the major support. This was the ceiling throughout all of December. Remember the rule. Old resistance becomes new support. If the price falls to $75, it should bounce hard. The entire market is watching that number. Banks, algorithms, and physical stackers all have buy orders sitting at 75. If we break below 75, then we have a real problem. That would invalidate the breakout completely. It would signal a failed move. But right now, we're more than $3 above that danger zone. We have a massive cushion. So don't let a 3% drop scare you when you have a 20% buffer protecting you. Let's look at the RSI, the Relative Strength Index. Yesterday, the RSI on the daily chart was pushing 80. That's overbought territory. It means the engine was running too hot. It needed to cool down. Today's crash accomplished exactly that. The RSI has dropped back into the 60s. This is healthy. You can't run a marathon at sprint pace. You have to slow down, catch your breath, and recharge. The market is catching its breath right now. It's resetting the RSI without destroying the price structure. The market has recharged its battery. It now has the energy to make another run at $83 next week. If we had kept climbing straight up today, we would have crashed much harder tomorrow. So in a strange way, today's drop actually saved the rally. It prevented a blow-off top and replaced it with a consolidation pattern. Consolidations are boring to watch, but they're sustainable. They create the foundation for the next leg higher. We need to check on gold again because gold is the anchor. Gold is down $32 to $4,453. This is a 0.7% drop. It's a minor flesh wound. Gold is still trading near all-time highs. It's still in a powerful uptrend. Silver dropped 3% because silver is naturally more volatile. But silver cannot enter a bear market if gold is in a bull market. The physics of the market won't allow it. The gold to silver ratio widened slightly today. It went from 56 back to 57. This makes silver cheaper relative to gold than it was yesterday. This attracts value buyers. The algorithms that trade based on the ratio will step in to buy silver and sell gold to close the spread. So gold is acting as the anchor. It's preventing silver from drifting out to sea. But I need to warn you about something that's coming tomorrow morning. You're going to see headlines tomorrow that say, silver crashes, the bubble bursts, investors flee commodities. The media loves a crash story. It generates clicks. They'll completely ignore the fact that silver is still up massively for the month. They'll focus entirely on the one red day. Do not let the headlines control your emotions. The media doesn't understand the arbitrage dynamics. They don't know about the GSI B-flush mechanics. They're just reporting the price movement, not the underlying structure. You understand the mechanics now. You know this was a sell the news event triggered by the Bank of America report. It was a tactical flush, not a strategic failure. So the chart looks ugly, but the structure is still safe. The support is holding firm. The indicators are resetting to healthy levels. What do you do now? Do you buy this dip? Do you sell the bounce? Do you hold through the pain? Here's the recovery strategy. In the world of professional trading, amateurs open the market and professionals close it. The daily noise, the spike to 83, the crash to 78, that's just intraday warfare. The real trend is determined by the weekly close. We have 2 days left in this week, Thursday and Friday. The battleground is simple. The bulls need to close the week above $75. If we close above 75, the weekly candle will show a long wick but a green body. It confirms we're holding the breakout level. It tells the algorithms the trend is up but volatile. That's acceptable. But if the bears manage to push the price below 75 by Friday afternoon, it prints a failed breakout on the weekly chart. That would signal a deeper correction is coming. So your eyes should be locked on that $75 line. It's the difference between a temporary dip and a trend change. Given the physical shortage situation and gold's strength, the odds favor the bulls holding that line. Now let's revisit the Bank of America target, $309. Today, looking at $78, that number feels like a fantasy. It feels completely impossible. But you have to separate timing from destination. Bank of America didn't say silver would be $300 on Wednesday. They said the fundamentals support $300 in this cycle. Did the fundamentals change today? Did solar panels suddenly stop needing silver? No. Did the US debt stop growing? No. Did the mines discover massive new silver deposits? No. The math that leads to $300 is still completely valid. But here's what nobody wants to hear. Inflation plus scarcity plus monetary reset equals triple-digit silver prices. Today's price drop was purely a sentiment event. It was about emotions and positioning, not about fundamental math. The math always wins eventually, but the math takes time to play out. If you bought silver because you believed in the $300 thesis, a $2 drop shouldn't shake you. It's a 0.6% pullback on the road to a 400% gain. Keep your eyes on the horizon, not on the pothole in the road. I'm going to give you the hardest advice in finance right now. Sometimes the best trade is no trade at all. When the market is whipping back and forth like this, when it's trapping long positions and squeezing short positions simultaneously, the best thing you can do is step away from the screen. If you try to trade around this volatility, if you try to sell at 78 hoping to buy back at 76, you will likely get whipsawed. The market will reverse the exact moment you hit sell. It's programmed to maximize your regret. So the strategy for the rest of this week is passive observation. Let the banks fight it out among themselves. Let the algorithms churn through the volume. You own the physical metal. You're outside the casino. You don't have to place a bet on every spin of the wheel. You already own the casino itself. Just wait for them to finish playing their games. However, if you're sitting on cash right now, if you missed the initial breakout at $70, this crash is your second chance. It's the market giving you another opportunity. We're back in the buy zone. Any price between $75 and $78 is a gift. You're buying a breakout asset that's retesting its support level. This is the lowest risk entry point you're going to get for months. Stop waiting for $60. 60 is gone forever. The new floor is much higher now. Recognize the opportunity hiding inside the crisis. While everyone else is panic selling, you should be calmly accumulating at the discount. So here's the final verdict on today's trap. Bank of America issued a report specifically to create liquidity. They used the retail excitement to either offload positions or reset their hedges. It was a cynical, ruthless move, but it doesn't change the underlying truth. And the truth is about to shock you. The truth is that silver remains the most undervalued asset in human history. The truth is that the East is systematically draining physical metal from the West. The truth is that the price is heading significantly higher, regardless of what happens on a random Wednesday in January. You survived the shakeout. You're still standing. Do not let them steal your conviction. Do not let them steal your silver. The path to $300 is not a straight line upward. It's a war. And today we took some shrapnel, but we're still marching forward. The double top at $83 looks scary on the chart, but double tops and supercycles often become bull flags. They consolidate before the next explosive move higher. The volume profile shows accumulation happening at current levels. Institutions are buying the panic. They're absorbing supply from weak hands. The weekly close on Friday will determine everything. If we hold above $75, the bull market remains intact. If we break below it, we'll need to reassess the short-term structure. But the long-term thesis hasn't changed at all. The Bank of America report wasn't just market manipulation. It was also a signal, the signal that institutional thinking has shifted permanently. They've gone from suppressing silver to promoting it. That's a tectonic shift in the market structure. The $300 target plants a seed in the collective consciousness. It normalizes extreme bullish outcomes. It creates the psychological foundation for a true mania phase. And manias don't care about technical patterns. They break through resistance levels like they don't exist. Today was designed to shake out the over-leveraged traders. It was designed to transfer metal from nervous hands to patient hands. If you panicked and sold at 78, you just gave your position to someone who will hold it to triple digits. If you held through the volatility, you passed the test. Most traders fail this test. They can't handle the emotional violence of a 3% drop. They sell at the bottom and buy back at the top. You're better than that. You understand the game now. The fortress levels between $75 and $78 are holding firm. Gold remains in a strong uptrend, anchoring the entire precious metals complex. The RSI has reset to healthy levels, recharging for the next move. The fundamentals supporting $300 silver haven't changed. The solar demand is still there. The supply deficit is still growing. The monetary system is still broken. Hold the line. Watch the $75 level closely. And remember exactly why you started accumulating silver in the first place. The war isn't over. We just survived the first major ambush. Now we regroup, reload, and prepare for the next phase of this historic move.